All right, well, welcome to the August version of Transaction Review and Calculator Practice. This is basically our community mastermind where you can bring your own deals, let us know what you're doing, ask for help, share some special knowledge that you have, because this is the time when we can all sort of work together and patch in any weak spots you feel like you have, whether it's in marketing and getting them, or building private money relationships, or just figuring out how to structure deals. But anyhow, so I'm really happy to have you along on this. We're going to go ahead, and here's the standard disclaimer. And, don't listen to anything I say. It's just the Note Queen. So anyway, I always like to start with a calculator practice just so we keep those skills up in real-world situations. So let's get at it. Okay, so here's a very, very basic sort of deal. And I'm going to bring up my HP 10B2 financial calculator by end-of-day development. So let's say we have a house that's worth $100,000 and it's not worth 90 and it's not worth 110. It's worth 100 and they sold it for 100. So that just helps us, keep square on it. When you sell with owner financing, there's some merit for being able to add a premium, maybe 10% higher or 10 or 15,000 higher, depending. But when you go to sell the note, it might compromise the value for the note, because really the note buyer is going to say, hey, what's the value? Not what you sold it for. If you greatly increase the sales price and the cash value is quite a bit lower, it's going to compromise what you can sell the note for, because we need to feel secure based on the value of the property, just kind of like a hard money lender would be, collateral-based lending quite frequently. So anyway, let's say this buyer, maybe they were a long-time tenant and you own it free and clear. They're going to put $10,000 down, and they're asking you to carry for them because maybe they have a little bit of bruised credit, had some medical issues, whatever, a divorce, a bankruptcy, something like that, where they're not quite in a position to be able to get financing, but they've got a good 10% down payment. And so the note and mortgage they're asking you to carry for them is $90,000. So the first thing I'm going to do when I'm figuring out, putting these owner carry deals together, and something you should think out, we want to set up the borrower for success. So the first thing we're going to do, what can they afford? When you use a licensed mortgage originator to underwrite the file, there's certain debt to income ratios that they're looking to stay below, because historically speaking, those make it so that the borrower has a good chance of fulfilling on the obligation and not losing their house and their investment. So let's just say that this buyer, a lot of times tenants don't know to think to add in, those extra expenses that come up when you're an owner, like little things that you have to fix that when you're the tenant you have someone else do, or they're not used to taxes and insurance and things like that. So basically, you just got to help make sure that they understand. So let's just say $1,200 is the max payment that they can afford, okay? And let's just say that T&I, taxes and insurance, is $225 a month. So if the max payment per month that this buyer can easily afford is $1,200, then that has to encompass PITI, principal, interest, taxes, and insurance, and HOA if there is such a thing. So in this case, we're going to pretend that taxes and insurance are $225, so I'm going to take that out of the amount that's available for the mortgage payment, the principal and interest. So the max monthly P&I, or principal and interest, that this buyer can afford is $975. So I'm going to put that, I always put these two as negative numbers, so I'm going to make that a negative number right here, and I'm going to enter it in the payment. So I know that's the most they can afford. We know that $90,000 is the note and mortgage. That goes right here in present value, PV. This could also be called loan amount. And let's just say that the highest rate the buyer will agree to pay is 8, and that's still a good rate for the seller, basically giving private money. And so that's pretty strong and will help preserve the value of the note in the secondary market. And so here's the question. What is the fully amortized term? When we know any four of these, we can figure out the fifth one. So future value here is 0 because there's no balloon. It's going to be fully amortized. We know this is the max monthly payment. We know this is the loan amount or present value. We're plugging in 8% for the interest or yield. So now what we don't know is how many months does that turn out to be? Okay, that's really close to 144, right? So basically that would be a nice clean amortization schedule. So we're going to put 144 in there, and then we know something's going to change. So if we do that, I'm going to go back over here and solve for payment. So in this case, what we're going to do is make the monthly payment $974.21, which is that number it's below the number we're trying to stay below there, so they can have a good chance of fulfilling on their obligation. So hopefully that was easy enough, and I want to let's just take this next one and keep working with it just a little bit. So here's the note that we have, right? 90,000, 8%, N is term. That's the number of months in this case, 12 payments per term. So we have 144 of these, okay? And let's just say that the note seller, after he receives 12 payments, he wants to sell the note. He has some need for cash, some medical expenses, needs a car, has a grandchild going to college, whatever it might be. So let's see, now switch to the investor. If an investor wants a max ITV of 65%, well, what's ITV? Investment to value. Because if we're buying the note, we're not making a loan. The guy who sold the property, in the first example, he wasn't making a loan, he was offering terms, but basically he was originating the loan, and that was a 90% loan to value, owner carry note. But when I'm coming in on the secondary market, I'm going to think more like a hard money lender, and I want my investment to value, the amount of money I have at risk against certain collateral, to be, I like that 65. Sometimes in some states, in some situations, I'll inch up from that, and it's the opposite is true. Sometimes I won't be over 50 in some situations, just because if anything goes sideways, I want it to be really, really hard for me to lose the principal. I mean, it's bad enough if your yield kind of goes through the ground, but if you lose your actual principal, that's pretty painful in an environment where people are, scrambling to keep their money and keep their returns and their plan for retirement on track. So first we're going to figure out safety before yield. Safety before yield. So what's the value of the property? We said that this wasn't an inflated number, right? So this is the accurate, what would it appraise for, or a broker price opinion. So and I want 65% of that times 0.65. So the most I could pay for this note is $65,000. So we know that he's already received 12 payments. So what do I have to do here? Well, what do I have to do with the 65? That's the present value of what I'm going to buy the note for potentially. So I'm going to stick it here in present value to see if I keep myself safe, does the yield make sense? But I know I don't have 144 of these. So I'm going to press this recall button to get this up there. 144 minus 12. So that's good seasoning. It's 1 year of seasoning, making the note taste better because it has lots of salt and pepper. Proof that the buyer can pay on time in a predictable fashion. So I'm going to stick that in there, 132. Now, so what will my yield be if I spend $65,000 to get 132 of these? I wonder what my yield will be. Well, 14. That's more than my minimum 12% return. Great. Okay, that would work for me. So it's just a matter of, will it work for the seller? Because this would be, at least even if the note was paid down, at least be a $20,000 or so discount. So if they agree, then this is a perfectly great transaction. But if they say, wow, I was really hoping not to take that much of a cut to my to the paper asset, my note, but I really need 50. If I only need $50,000, what can you do? And so let's figure that out. So now I'm going to put 50,000 in here. They only need 50,000. So I'll put that in PV. I'm going to leave this yield about the same. It's okay for a little bit less or whatever. Now I know if I'm getting this many payments, paying this much, and this is my target yield or thereabouts, now I need to solve for N. I wonder how many payments of the note that I'm going to be buying. And that works out to about 80, right? So if I buy 80 payments, what is that? 7.5 years. Then my yield will be 14.25 or a third, something like that. So that's really awesome. And how does this benefit the note seller? Where they got their 10,000 from the sale payment from the buyer when they sold the property. Now they're getting 50,000 to sell and giving away 7.5 years of payments. But what are they going to have at the end? So we know if they're selling me 80. Okay, let's put this note back in here. Sometimes it can get confusing. So lots of times I go back around and I'll recreate the note as it was originally conceived so that I know everything inside and I'll solve for payment again, just so that there's many decimal points that are hidden. So I want to recreate the note for accuracy. So we know that here we have N. There were 144 payments, and we know the buyer already received 12. And if I'm going to buy the next 80, there's going to be 52 payments left, right? So if I put 52 there, I wonder what present value will be. How much of the note will still be left? Looks like they'll still have a balance of 42,000, almost 43,000. So you can see that for a $90,000 note, they can get 50 and still have 40. Basically, on paper anyway, we have some time value of money issues here, but you can see that that's not really a discount, not a very heavy discount. They got to get the cash they needed up front without losing all those remainder payments that they have. So 52 payments, so if that's 42,000 in balance, 52 times 974.21, that equates to over $50,000 if you just add up the payments. Okay, so anyway, I hope that was helpful. If you have any questions, go ahead and type them in. All right, and again, if you being part of this community, if you have any specific questions or things, if I don't know the answer, I can pull guys in that can demonstrate a lot of fancy things on these things to help us. So please ask questions so that these masterminds are as helpful as possible to you. All right, I'm going to put this down for a second. All right, so a lot of people, in fact, this week I got an email from someone who said, look, how do I, actually in the last 7 days, 2 emails from people that are saying, how do I get started with nothing? Or how can I jumpstart my business? And it seems like such a long way away. And in my opinion, there's a lot of different skills sets that you can acquire and concentrate on, but I think the ability to raise private money is one of the strongest, no matter if you're going to invest in property or paper, real estate or notes. So here's the problem. Many people want to get started investing in notes or brokering, which is wholesaling notes, like a lot of people wholesale properties or broker properties, but they don't have a lot of their own money to work with, and they don't want to or can't spend 2 to 5 years building a business where they easily generate good note leads month in and month out. Because there's no special sauce here. The note business is a business like any sort of business that you're starting. So it can easily take 2 to 5 years to really catch your stride and get going. if you put a lot of effort into it. So that really is a job. It's a career. And then there's another problem on the other side. Many people who do have money don't have the time or inclination to invest it actively, yet they want the safety. The stock market could easily drop over 50% in our next downturn, maybe more, and banks are paying less than 1% if you just keep it there in a quote-unquote safe place, and that's kind of hard to retire on. And who knows if negative interest rates are going to hit us over here. We don't know. So the solution for me is create a win-win solution between the sweat equity, that's the person willing to look for the deal, and the capital. If you can create a financial network, you can start making money in notes today. I mean, like right now, just you're flooded with opportunity. If you can get your financial friends in order and people that will partner with you. There's no waiting 2 to 5 years, nothing. So it's a super, super valuable skill. So what kind of person do you have to be to attract good financial friends? You have to have some education. There's really no way around that. You need to understand the basics of the business. You got to be familiar with the standard terminology, understand the basic due diligence and things you need to look for, and you have to have basic financial calculator skills. You don't have to be fancy. I basically know how to use the top 5 buttons, well, a little bit more, but basically I just say, I only know how to use the top 5 buttons, and I'm overseeing a fairly sizable note portfolio right now. So you don't have to be a whiz at this stuff. Just learn those 5 buttons, and it'll really set you free. Character. Why should someone trust you? Do you have integrity? Do you always do what you say you're going to do when you say you're going to do it? You know, if you constantly say you're going to do things, even just like, oh, I'm going to send you that tomorrow, or I'm going to call you. I mean, I'm bad with this. Like, my poor web guy, you know, I'll say, oh, I'm going to get you the slides for this thing. I don't have integrity with my word with getting my presentations together. So that's not good. I need to tighten that up. But in the money department, I always do what I say when I say I'm going to do it. It's very important. The small things are really big. And do you authentically emanate a core value of helping and protecting others before yourself? You know, if you need to look in the mirror and really see if there's things where you need to tighten up and be impeccable with your word and with your intention and with your basic intention of what you're trying to do and what you want. Like, are you a me first person, or are you really trying to serve others and you'll take the hit before you let them, right? That's what you need to cultivate, in my opinion. And then relationships. Not only do you need strong relationships with your financial partners, but you need to build solid relationships with the people, like the rainmakers, the brokers, who can bring you the deal flow. If you do, you can create passive income out of thin air right now without any of your own money and be doing a lot of people a big favor in the process. So just to tell you, when I started, you know, by the time I had a nest egg when I quit my nursing job in 2004, but it wasn't big enough, I'm going to tell you that. And by the time I finally caught my stride and felt like I was really ready to go, I was out of my own dough. I didn't have a lot of money to invest in notes that was mine. So basically I was forced into a situation, and it was good. It all worked out beautifully, just the way I think it was supposed to. What I realized is people wanted to partner with me, and I was ready to step up to the plate and say, you know, I've been studying with this thing and dancing around it, and I'm ready to pull the trigger and go for it. And I had people just sort of begging to come along the ride with me, so that worked out really beautifully. So, and everyone who invests in real estate and other things knows the power of using other people's money, and it's not just like you're being a user or an abuser. You're actually doing them a favor, because, you know, they want to be doing their art or running their business or playing golf or traveling and visiting their grandchildren. They want someone who can safely grow their money in a passive way. So let's just go back to this same note that we started with. We're going to put this back in. We're going to recreate it all over again. And when I'm like doing the business, I don't do it once or twice. I'm always recreating it and going back over it and what if this and tweaking it there. So I might re-enter the basic note information a dozen times when I'm putting a deal together. Okay, so here's the deal. So remember how I needed the guy, if I was going to pay, how many payments I was going to buy from him, like 80 payments, 7.5 years, because I plugged in a 14% yield, which for me, it makes sense, and I need to be able to have a spread on the money and have some wiggle room there because this is my business. I need to put food on the table. So, but what if the note seller said, no, I'm not going to take any sort of discount. Okay, I would never buy a note without any sort of discount, but that's besides the point. Well, because you're going to have some closing costs, so if it pays off the next month, they refinance or sell a property, you're actually out of pocket a few bucks because they only owe you the balance of the note. It doesn't matter that you came out of pocket for closing costs. So anyway, but let's just say that if you could buy it at par, which means you could buy this note at an 8% yield at face value of the note. That means the yield that you need is the exact same yield or face value on the note. How many payments would you be buying? We saw that if I need a 14% plus yield, I was buying 80 payments. So let's figure this out. We got this, the note seller needs another $50,000. We're going to leave this the same. So all of these, we know there's no balloon, nothing in future value, payments the same, 58. Now let's solve for how many payments that means we need to buy. Wow, we only need to buy basically 63. I mean, I would try to say, hey, can I, cough up an extra payment? You're giving me 8.5 there, okay? So basically that's for 16 fewer payments, right? And maybe the seller will go, yeah, I'll do that all day long, whereas they might reject the other offer. You never know. People have different motivations. So if you have someone that has a great note and they won't take a discount or a very big one, here's how you can still make money on that all day long. Super easy. Okay, so we see, what did I ask here? Yeah, how many payments will we be buying? You can buy the partial payment stream at or close to par. Okay, so we're just 8.5, very close. Okay, now if your private money partner feels great with the safety, right? So they're only bringing $50,000 to the table, and we're dividing by the value of the property. That gives us 50%. We're at a 50% ITV, investment to value. So they should feel pretty safe about that in general. And let's just say this is a type of person who they usually feel lucky if they make 1 or 2% in CDs or other sort of money market accounts or something. So you're offering them double. And what if they're happy with 5%? By the way, these aren't the people you're going to find at the real estate investment clubs. They're all have this yield expectation that can be, I find, generally unhelpful in terms of my own portfolio. But there's a lot of people. I mean, there's friends of mine who are longtime investors, and they have all the money they could need at 4% because they have the reputation. And they're paying a lot more than a bank CD and a money market fund and all that, and they really like and trust him. So anyway, let's just say they're great with 5%, which is many times what they'd make leaving it in a savings account at the bank. Okay, let's see how much of each monthly payment they will need to get their 5% yield. Okay, so here we know that they're going to put $50,000. It's ostensibly very safe, although there's always risk in everything. They're happy with what's the yield. Okay, let's put that in there, 5%. And they're going to hang in with us for the whole 64 payments that we're going to buy from the note seller. So what don't we know? What do we need to solve for now? We want to know how much of the payment this guy needs. Okay, to get a 5% yield, amortized over just over 5 years here, he's going to need $891.66. So how many of the, let's see, how much is left over for you each month then? So you put the deal together. You didn't have to find it because you can find, you can buy notes all day long that are good, solid for 8, 9, and 10% yield. So if you're not the rainmaker and you can just create a yield spread for yourself by cultivating these money partners that are good with these lower returns, you know, you don't have to create a business. It's just like going out there and picking up, you know, Easter eggs. I mean, it's just everywhere. It's just ripe for the taking. As long as you can learn how to do your due diligence and work with people that you know, like, and trust, who have integrity and a good reputation. So what's left over for you? If the guy brings in all the money, you didn't have to find a deal. You just kind of put it together, learned a little bit, learn how to talk and present the offer. He gets his 5%. So I mean, just to keep it simple, I'm gonna add the payment. What is it? I want to say it's it was just under 975. I want to say it was that. $82.55 a month is passive income out of thin air that you get to keep because you're working the yield spread, the arbitrage there. So $82.55 doesn't sound like a lot of money, but how many of these would you need to cover your rent or mortgage payment? If you did this 10 times, you'd have 820 passive income. If you did it 20 times, I mean, can you see how fast? I mean, some deals might be better, right? So I just wanted to show you that having private money partners is every bit like so powerful that people overlook this all the time. In terms of, how do I get started? How do I make money? I don't have any money. I don't know that you can, you know, sidestep the education. It does cost some time in education. If you've got no money, you're going to spend a lot of time searching free sources or very cheap sources and things like that. Otherwise, it's usually will speed your process if you have some capital for education and connecting and going to conferences, so that you can do what? Create relationships with the people that have the deals. So if, you know, I have a deal, I have a few deals every month that come through my plate. There's a lot of brokers out there where you can buy notes through them, and there's some very reputable ones. So you need to create relationships. So it's easier if you do have some money for some of that. But this basically, when I started focusing, I kind of had a rough transition between W-2 and entrepreneur, you know, till that the income smoothed out. When I shifted my mindset from needing, you know, to make a killing on any one deal, and all I thought about is, how do I add a little more passive income today than this month, last month, and even if it was just like $40 or $50, I would just be so happy, and I would just, like the turtle approach, right? I'm not running like the hare. It's just a slow, steady, a little more passive income than I had last month, you know. And then before you know it, like, I looked back, and like in a year and a half, I had, you know, a fairly sizable mortgage payment covered on a passive basis. That was basically created my base salary for myself. So then I'm not scrambling and stressing, and the less you stress and the more easy flowing you are, then the easier it is for other opportunities to be attracted to you and rendezvous and drop in your lap. So to me, this was a life-changing, completely life-altering thing to go on. Now, I never really got 5% money because the going rate, you know, generally my investors are getting 8 and 9, 10 if it's a commercial deal, or maybe super long amortization. But still, if I'm buying, you know, at above that, if my basic yield that I will buy is 12%, I'm always creating at least usually a 3-point spread, generally more with the lower notes. The smaller the note, the higher the yield, because it still has to be worth the time to push the paperwork, because the little deals take as much time as the big deals. So a lot of times people are surprised to learn that, you know, the small notes, you have to have a higher return, at least I do, to make it worth my time to put it all together. So anyway, if there's any questions, we can move into that. And if you're watching this after the fact, please, and you have things that you want us to cover next time in our mastermind, please be sure to email so we can work you into it. I really appreciate you guys being part of this community, and I will catch you next time. Thanks again.